Give me 1 second and we can get started. Setting up real quick. Making sure everything looks good. Okay. Hey there, Lincoln here from bullacademy.org. Today, let's talk about what happened this week on the stock market. It was a short week, but a whole lot happened, and we have a lot to cover. So, if you enjoyed this video, make sure to like the video below, subscribe to the channel, hit the notification bell, comment your thoughts, and in the live stream, let me know what you're thinking. We'll get to live stream soon, or in a live chat of YouTube down below, and we'll definitely get on touch on those as we always do. So, and of course, if you're a patron, join us in the live stream chat in the Discord channels and let me know what you are thinking as well, and we'll cover those too. Of course, our patrons are a priority over here at bullacademy.org because they help the channel keep going and they support us financially. So, if you want to become a patron, help the channel grow, reach more investors, get more access to me, and get direct answers to your investment question, then join us over at patreon.bullacademy.org. You'll be able to engage in our Discord channel where we discuss the stock market every day in real time and get early access to my research and all of the things that I'm thinking about. Of course, we all share our own knowledge and thoughts and perspectives to help one another find new deals and getting early on deals like CCIV, SBE, ChargePoint IPOE. We got in early on CCIV Lucid Motors at $12 per share, and we rode it up to $65 per share, and now we're back down to around what, $25, $30. So that's the value of being in a community and having one another here to support each other through the ups and downs as we've seen over the last few weeks. So I would love to have you over there if you aren't a patron yet. But with all that said, let's dive into what happened this week. And in the live chat, we have Claudius says hello, and Anthony Lee says, hey, everyone. So do share your thoughts in live chat, and we'll get to those soon. Let's jump in. So this week, ending April 2nd, 2021, we had a lot to cover, as I said before. And before we get to all of the big news, I just want to say congrats to you if you've been holding in there through the downturn that we just had over the last month, and where some people like myself lost about half of the portfolio value after going up from $170,000 to $345,000, and then back down to $170,000 again. So we've been on a rocky road. We've been going on a roller coaster, and I showed you guys a couple weeks ago, maybe last week, my portfolio and why it went down so sharply over the last few weeks, and how I'm holding in and making sure that I don't panic sell and actually lose money. Because on this channel, we invest for the long term. That's what we preach here. The bull mentality. The bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term. Because that's how we build wealth in this country. That's how we give ourselves the best chance of success on the stock market. So that's exactly what we did, and we've benefited greatly from just holding in there, right? We've gone, myself, I've gone from what, $7,000 when I started to now over $170,000. So that's the value of just holding in, right? Being bullish. and being long-term minded, just holding in there, not panic selling, not trying to time the market, not trying to do fancy options tradings to figure out when the market's going to go down or up or whatever. Just buy companies that you believe in, hold it, and just continue to add to it when the market turns down. So when the market was down over the last few weeks, I continued to buy my highest conviction plays, which were IPOE, CCIV, Tattoo Chef, right, and Jumia. So that's exactly what we do. We buy and we hold, and we continue to double down on our positions as long as they continue to make sense. Just because the market goes down doesn't mean that we have to change our strategy. It doesn't mean that we were wrong, and if the market goes up, doesn't mean we were right. But what we do know is that we have our own beliefs, we have our own opinions, and we have our own valuation metrics or strategies, and we have to stick by them. And if we do that, we will be. The history has shown that we have a better chance of success if we stick by our strategies for the long term, not trying to time the market. So, with all that said, we've seen a glimmer of hope this last week when the market continued to go back up. Right, we were down a whole lot, but this last week, the stock market at S&P 500 went up about 2.36%, broke 4,000 points for the very first time. And the NASDAQ composite is also up 3.54%. Russell 2000, the smallest 2,000 smallest companies on the stock market, were also up 2.25%. And the VIX, the volatility index, is down 11.4%. So all of this is very good. And let's just look at some graphs real quick. And we can see all of this in picture. So that's the first one. Let's actually look at this one. Yes, we'll get to some stocks in a second, but let's look at the S&P 500. And as I just covered, S&P 500 is doing well, the Dow is doing well, the Nasdaq is doing well, and we can see the volatility index here. When the volatility index is up, these indices are down, right? But when it goes down, we see the exact opposite. These indices go up, right? So the volatility index tells us just how volatile the stock market is, how much fear there is in the market, right? That's what we can perceive from this graph. So we've seen over time pretty consistently that when the volatility index is up, the stocks go down, and when it's down, the stocks are going up. So as we can see here, the volatility indexes continue to go down. The indices are going up, which might mean that we're in good hands, that we are getting out of these downturns, right, that we've continued to see over the last few weeks. And of course, we had some times where we had some green days, maybe a few green days, but over the last few weeks, we've just been going down, down, down. And I've showed you, let me show you my own portfolio. And my portfolio is doing all right. It's not as well as it once was, but it's doing all right. We're hanging in there. So over the last month, I am down 17, or no, what is this? I'm actually up 17%. So that's interesting. And as you can see, over the last 3 months, I've gone up from $170,000 all the way to 345, and like I said, back down, right? But now I've been coming back up. So this is pretty representative, or as you can see, my portfolio is tracking the market pretty well too, where it's going down similar to the market, and then it comes back up. And I've just been holding, right, like I've said in the previous videos. So that's just a quick roundup of what's been going on the indices and my own portfolio. But let's keep going to why the market is doing pretty well, and everyone seems to be getting excited about the market again, even though people love to run off at the slightest sign of bad news. It seems people are coming back now that we have some good news. Jobs. We're getting back to work. Employers are adding more jobs. They've added 916,000 jobs in March, which is the biggest gain since August. And CNN reports that it's a 96% increase over February. So the question now is inflation coming sooner than expected? Was Jerome Powell wrong? And I would I say that we should probably slow our gun and not try to jump it, right? Because although we're seeing jobs coming back, we're still around 50% down from where we were before the pandemic came in, right? Before in March and April of last year. So we've lost lots of jobs and we've only recovered about 50% of them. So we're not out of the woods yet. But there, like Jerome Powell did say, that we will likely see some inflation for the short term this year. But he doesn't believe that's going to sustain for the long term. He still believes that over the next few years, we're going to have to continue to keep our foot on the gas with monetary easing so that we can continue to get this economy back to where it should be and get to maximum employment. But yes, we might see more inflation this year. And then there's Kramer's 5 stages. We talked about this last week, where he discusses that there's 5 stages of grief, and we've been through the last the four stages. We're waiting for acceptance, where the stock market just plummets in one great fast flash crash, and we haven't seen that yet. We haven't seen the market go down by 25% or by 10% or by maybe even 50%, right, in a few days. So we were expecting that, but it seems it's not coming. So the question now is, are we out of the woods? Are we going to just continue to go back up into a bull recovery? Are we going to be are we going to continue to grow, right? Like, are we going to go back to the moon as we were back in, what was that, February 17th? And just avoid that big crash. We haven't had a huge crash even since last March and April. And even before then, we've just been going up and up and up. And we're still pretty far up above where we were in 2019 when I started investing in the stock market. So time will tell. We'll see how this market does over the next few months as we get further and further into this recovery of the economy, as we continue to deploy the COVID vaccines and people get back to work and outside spending more money. We'll see if the stock market continues to go up. And I'm not really concerned about the short term. I think that over the next few years we'll be just fine. But it's always good to check in and see how the market is doing. So let's get now to some stocks. I know you all are here for the stocks, so we're going to cover stocks. We had to get through the boring stuff first. So thank you for sticking in there with me. Before we get to that, if you enjoyed the video, make sure to like the video below, subscribe to the channel, hit the notification bell, and let me know your thoughts in the comments in the live chat below. And we have Franco asking if we can check some stocks. So yes, we will check some stocks in a second. And before we get to that, if you want to help this channel grow, support us, then join us over at patreon.boacademy.org, and you can discuss in our Discord channel how we're making new moves in the stock market, what the rumors are, and how we're all feeling about these downturns and the recoveries and all of the emotions that come in between, right? So join us over at patreon.boacademy.org, and I would love to have you over there. So let's continue to move on to Compass. Compass is pretty much a platform for real estate agents to pretty much build a business and help more of their sellers and buyers close more deals, right? So Compass pretty much seems to want to be the Shopify of real estate. And I've actually worked with a Compass agent, and their site is pretty advanced beyond what Zillow and I believe Redfin offer. So if you go on Compass, they have virtual tours. I don't think Zillow had that for a while, right? But Compass made that very easy to use. And some listings that are on both Compass and Zillow and maybe on Redfin won't show you a virtual tour on Zillow, but it will show you a virtual tour on Compass. So Compass has some benefits for both the agents and the sellers and the buyers, right? So they make it very easy for these agents to work with their clients. And that's why they've been able to attract thousands of agents, real estate agents, to their platform. And they're now the third largest real estate broker out there, right? Behind, and that's by sales volume. Let's see their competitors. So if we look at this this table, we'll see Compass, Compass is the third on this list of the, what is this, 500 what's it called, most grossing or what's called real estate brokerages out there. And this is the first one. They made $170 billion in sales in 2019. The second, Home Services of America, made $132 billion, and then Compass did $91 billion in sales volume in 2019. Right. So, and then there's Redfin down here, number 5. Redfin did $30 billion in sales volume in 2019. So obviously, Compass is pulling its weight. It's been growing super fast since 2018. If they 4x their revenues, their sales volume in the last 2 years, right? And they're heavily funded by SoftBank, and we can see in this graph right here, the more funding they have, the more they can afford to hire more and more real estate agents. So we have this funding graph in the orange, and as that goes up, we see them continue to exponentially add more and more agents, right? So in 2017, they were at around maybe 2,000 agents here, and today they're over 18,000. And of course, we have the most recent numbers, which is 19,000 real estate agents. So they had a pretty good IPO on April 1st, April Fool's Day, and we can actually look at their graph right now. Let's take a look. Compass stock. So this is their, what is this, 5 days. They went public on the 1st, and they're up above where they went public, but since then they've been down about 5%. So they're doing all right, but not as good as they would have liked. They had to downsize their offering, and they've been getting some criticism lately about how they treat their real estate agents. So it's a promising company, but there are some problems that they have to overcome in the short term, like culture and how they treat their agents. Of course, they gave their agents equity, but that came with some strings, like 5% of your commissions, 10% of your commissions, and if you left, then you will lose that. So not exactly the best setup, but it's definitely better than many of those gig economy platforms out there, like Lyft and Uber, who didn't give their drivers equity. I'm not sure about Lyft, but Uber definitely. So I'm still looking into Compass. I'm not sure if I want to invest in it, but I'm definitely looking into it. They're growing very fast, and they're, as we saw on this table, they are challenging the top players in this industry. So I think they can continue to be a contender in this industry, and hopefully for them, they can realize their dream of being the Shopify of real estate, making it easy for real estate agents to set up their own home pages, their own landing pages, and drive more customer sales through their platform with marketing and sales materials and all of that, right? So I think it's a good platform. I haven't looked too deep into it yet, but just as a consumer using it, I like it. So we'll see how they do over the next few months, but let's keep moving on to Achegos, where things get a little bit more frustrating, a little bit more complicated. And if you haven't heard about Achegos yet, it's a pretty annoying news event, but pretty much this family office, pretty much a rich person who has lots of money and can afford to work with the best banks out there. He goes to them and say, "Hey, I have this great plan. I want you to buy these stocks, and I will pay you a fixed amount and a plus interest over the next few years, whatever the terms of the deal was." And so he went out there, he had them buy all these stocks, but he didn't disclose to them what he was buying. Of course, they put up the money, but he bought the stocks. So he didn't tell them what he was buying. And it turns out that he bought majority, large ownerships of Viacom and of Discovery and some Chinese stocks and other U.S. companies. So that was going to be great if it worked out, but it all turned around on him and all the banks came in and said pretty much, hey, we need our money now because your stocks are going down. We're calling you on your margin. You have to pay back the money you borrowed. And because he couldn't pay it back because it was leveraged 6 times, he borrowed 6 times the money that he put up to invest in these companies. And when it turned down, when the markets went down in the last few weeks, he couldn't afford to pay back the money that he borrowed when the bankers came calling for their money. So what the banks did in response is they sold off his assets. That's what happens in the margin call. If you borrow money and you can't pay it back, and the banks call and say, hey, I need my money back, and you don't give it back to them, they say, okay, cool, we're gonna sell all your stocks. And that's what they did. So they sold Viacom, they sold Discovery, and what that caused was continued downturns for those stocks and many others. So if we look at Viacom stock, we can see just what happened over the last few days. So let's look at this. So they were at $65 per share on March 26th, so last week. And then the whole debacle happened this week, and the stock went plummeting to $44 per share. So now it sits at about $44.50 per share, which is far below where it was in March. And this is what happened. Let's see Discovery as well. Discovery stock, same exact graph, right? $57 per share last week, and then the margin calls happened to Achegos, and down they went, $43 per share. So again, the bank screwed up. This guy was a fraud. He pleaded guilty on insider trading back a few years ago, maybe a decade ago. And they said, okay, you're rich. Here is more money to go invest in things, even though we know you're a shady character. But here's more money. Here is 6 times the money that you have to go invest in companies that are quite questionable. And your strategy is questionable too. So they gave him all this money. He put up $15 per share, or $15, and they gave him $85 to borrow. And he went out there and he invested in a bunch of stocks that he probably didn't know too much about as a hedge fund, right? So the bankers and the hedge funds, they keep screwing things up. And who gets hurt? The retail investor, right? The whole market suffers from these hedge funds and these bankers doing dumb things. So smart money isn't exactly that smart. They keep screwing it up. And the regulators keep missing. They keep failing to prevent these things from happening. So it happened again. And this time Yellen says she's going to bring back some Obama-era regulations to tighten up the scrutiny on these hedge funds, which is good, right? They're going to regulate these hedge funds more. And that's all we're asking for. Do your job, regulators. Stop letting these people just destroy the market. Every time they do dumb things, and then we get hurt. But we don't get to do dumb things, right? We don't get to invest in private companies. We don't get to invest in IPOs for the most part. So they overregulate us, but they don't regulate these hedge funds enough, these bankers enough, and then we all get hurt. So that's pretty much what happened with Achegos. Let me just read you a few lines from CNBC's article just to give you more clarity, because I'm sure I didn't explain that the best. But let's just look at this real quick. And before I go on, Black Buddha says that's exactly correct. So this article says last week a fire sale of shares held in a family office, Achegos Capital Management's name, rattled equity investors globally, even though the impact was restricted to a handful of stocks. Complicating matters for the markets and regulators was the lack of information about the stocks in Achegos' portfolio. Despite owning huge positions in stocks in Discovery, Viacom, CBS, and many U.S.-listed Chinese stocks, the fund was able to keep those a secret from the market. That begs the question: how did Bill Hong owned Achegos manage to do that? Let us break it down for you. So they go on to say that according to reports from Bloomberg and Wall Street Journal, Achegos built up these large positions through a derivative instrument called total return swaps. And this is what I explained before, right? I explained how it worked, but let's just look into exactly how it works just so you have full clarity. So according to this Forbes report, family offices are required to report stock and derivatives positions above $100 million in 13F filings to the Securities and Exchange Commission. And however, swaps are excluded from this 13 filings requirement, right? So he got away with all of this and he flew under the radar because he was doing these swaps, which are now required to be reported. So that's how he got away with it without anyone seeing it. But then let's look at what these swaps are. So the article says a total return swap is a swap agreement in which one party, Achegos in this case, makes payments based on a set rate, while the counterparty, the bankers, makes payments based on the return of an underlying asset, shares in this case. This includes both the income generated, dividends, and capital gains, appreciation in the share price. So as I explained before, Achegos makes payments to these banks. The banks put up the money to buy the shares, and the banks pay Achegos, will pass through the appreciation from these stocks to Achegos. So if the stocks do well, Achegos makes up like a bandit. They make lots of money, and all they have to do is pay them a fixed rate ongoing. But it doesn't always go well because the stock market goes up and down. So the article goes on to say that Achegos borrowed money from the investment banks like Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, didn't say that correctly, and got them to buy a basket of stocks. It paid the banks a fixed, pre-decided fee at a regular interval, plus the interest cost for the borrowed money. In return, the banks paid Achegos the capital gains on the basket of stocks at pre-decided intervals and also dividends, if any. So lots of upside for Achegos if they do well. So now, how does this agreement benefit the buyer of the swaps? The article says the buyer can build up large positions without the market knowing about it. Plus, the buyer has put up very little of his own money up front, and according to the Wall Street Journal, Achegos was putting up $15 of its own capital and then borrowing $85 against that. So a lot of margin, about 5.667 times what they put up. We can't do that and get away with that. Of course, we can try it, but we're going to get hurt very bad. So the article goes on to say what happened in the case of Achegos and explains what exactly happened this week when Achegos was margin called by these banks. Achegos had total return swap agreements with multiple investment banks for the same set of stocks. The banks were not aware of this, and as a result, Achegos managed to build up huge positions without having to make the required disclosures. So again, the fraud is frauding, right? In doing so, Achegos ended up overextending itself without enough capital to fall back on. So when the margin calls came, he couldn't pay it because he didn't have enough money because he was over leveraged. And as long as the share prices in Achegos swap portfolio kept rising, the fund profited hugely. Trouble started when the share prices began to slip, as we've seen over the last few weeks, and Achegos was inundated with margin calls from the banks which were holding the shares. Once it became clear that Achegos could not afford to pay back their money, the investment banks started to dump the stocks. And as I said, Yellen is going to implement more restrictions on these bankers and hedge funds. And the same story again and again. They do bad things, they get slapped on the wrist, and then they keep doing bad things. But that's enough of that. Let's continue, and we'll get into some more news on companies that I'm sure you all are interested in just a second. So if you're enjoying the video, don't forget to like the video below, subscribe to the channel, hit the notification bell, comment your thoughts, and of course in the live chat below, let me know what you're thinking. And if you want to support the channel, join us over at patreon.boacademy.org to discuss the stock market in real time in our Discord channel. So I hope to see you over there. And let's move on to IPOE, SoFi, and see what news we have, because there's some pretty big news on the horizon for this company. So as you know, I'm invested pretty heavily into IPOE, SoFi. I've covered exactly why in many videos before, so if you don't know why, go check out our channel at bullacademy.org. And basically the reason is I want to own a bank, and I like that SoFi gives consumers, investors, and savers a one-stop shop to earn money, right? Savings account, invest, borrow, and then do all of that again in the cycle, right? So they let you invest your money in the stock market, in ETFs, in regular stocks, and they let you borrow money in personal loans and mortgages and student loans and so many other offerings that they have. But now they are apparently working on allowing you to invest in the stock market using margins. And the margin is exactly what we just discussed. Margin is great if you know what you're doing, but if you don't, it can be very painful when things go wrong. So SoFi is planning to let their customers on SoFi invest in the stock market using margin, and I'm not sure that's a good idea. It's good to give people the option to do what they want to do, which is invest using margin. And I do invest in more on margin, so I'm not against margin. I just think they're dangerous if you don't know what you're doing. But I like that SoFi didn't offer these dangerous instruments before, like Robinhood does and other brokerages do, because it's dangerous. It can get you in lots of trouble. But if that's what they want to do, it's gonna get them more customers using their platform, and of course continue to grow their top of the funnel, and then that drives more customers to their lending products like the student loans and the mortgages and the personal loans. So it's good for the company. I'm not sure if it's gonna be great for some of the users who get hurt on these things, but we'll see. I like the freedom of choice, but it could end in tears. And when margin calls happen, people freak out. They dump all their stocks. They never come back to the stock market. They abandon wealth creation and they stay poor. So that's the extreme bad side, and it can happen, and it has happened many times. So if you are using SoFi Invest and you see margins come up, then you know what they are. But before you start using them, I would do your own research and make sure that you fully understand how they work. And of course, they also are planning on allowing SoFi Invest users to invest or speculate on options, right? Options trading. It's not investing. It's pretty much gambling, right? Trying to predict which way the market's going to go in a short term. And of course, that can also hurt you because it's impossible to time the market. So if you don't know what options are, there's many videos on that. I don't want to cover that too much, but they do plan to introduce margins and options, which have been heavily requested by users. So that's good. They're serving their users. I just hope that they do it in a sensible way that will shield users who don't know what they are from hurting themselves. So let's move on to some more SoFi news. SoFi is planning on, well, not planning on, but they will be hosting the Super Bowl in 2022 at their stadium in Inglewood, California. In 2019, they bought the naming rights to the new stadium for the Rams, the NFL team. And the goal of that was to help build their brand recognition, right? So when you go to a football game, you will see their name on the building, right? Like you see the Staples Center, the Garden in, what's that, New York? And then you have who else is there? All these Quicken Loans with the Cavaliers, right? So when you go to these stadiums, when you go to these games, these sporting events, you will see the company that owns the naming rights on the building, and that will continue to build in your mind recognition for that company. So when you see their name one day, you might go say, "Hey, I should check this company out." And you go online, you say, "So what's SoFi?" And you see, oh, they offer all these great things, and then you start to use it, and then you learn more about the products, and then you become a loyal customer, which makes the company lots of money over time, right? So that's the entire strategy here. That's why they're paying $30 million per year for 20 years to have their name on this stadium. So I like the strategy. It's going to help them continue to become a household name, which is great for the company and then great for shareholders who benefit from the appreciation of the value of that asset. And if we look here, we can see some of the big events that are planned for this stadium. So the SoFi Stadium in Inglewood, California, is going to host the 2022 Super Bowl in February, and then it's going to host the NCAA, which is the college association football championships in 2023, and it's going to host WrestleMania in 20 what is this? Yeah, 2023 as well, and in 2028 is going to host the Summer Olympics, which are the best Olympics. So that's great news for this company. This was a very smart idea, right? They say, hey, we want to be in everyone's face. We want to be recognized by customers around the whole country. And an easy way to do that is to put our name on a National Football League stadium. And when people go to these events, they'll be hearing about us on ESPN, right? On Fox Sports and all of that. So I like it. I like the strategy here. And if you want to learn more, I have the links below. But let's keep moving. Let me just take a quick break, and then we can cover Tesla. So, actually, before we cover Tesla's big news, let's do the live drawing for the $200 monthly giveaway. And this is a feature. This is the value of being a patron of the channel. So let's dive into that. Let me open this up. Give me 1 second, and we can see who wins some free money. Give me 1 second. Okay, so I have the names of all of the entries for this month, March 2021, and we're going to draw 2 winners. We're going to see who wins $100 each. So let's add them to the list. And then what's going to happen, we're going to click spin, and we're going to select the winners. So here we go. First winner, let's see. Wow. Okay, Scott's very lucky. He won February too. So Scott, congratulations. Thanks for being a patron. I appreciate your continued support. And I hope that this helps you invest or do whatever you want with this money. So let's hide Scott and do the next person. So the first winner was Scott. Let me just mark that down real quick. And hit spin again. Second and last winner before we get to Tesla. And Mason is the second winner of $100 for March of 2021. And if you're watching, thanks for being a patron and supporting the channel. And I hope that this helps you invest as well. And if not, then you can do whatever you want with it. So thank you again. And that's it for March of 2021. So Mason and Scott are winners. Now let's get back to the video. So now let's talk about Tesla. So Tesla is, before we get to that, let me just do the plug real quick. If you want to be a patron, join us over at patreon.boacademy.org, and you'll get to engage our Discord channel and discuss the stock market in real time and that's where we share news, rumors, and perspectives on the stock market, so we can all find new deals and collaborate, and of course keep one another going to get through all the bad times and of course celebrate the good times. And you of course get access to my early research in companies. So if you're interested in all of that, join us over at patreon.boacademy.org. Let's move on to Tesla. So Tesla, Elon Musk is coming to us again to make some bold claims. He says that Tesla just might reach 1 million cars being delivered in 2021. So last year they did about 500,000 cars that they delivered in 2020, and he believes that they can double that this year. He also said we were going to have robo taxis in 2019, but that's neither here or there. So this is good news if they can pull it off, because if they can actually do this, then they will be producing and selling just about a tenth of what Toyota did last year, right? And Tesla's much longer than Toyota. They're still figuring out the production processes, and they continue to build new facilities around the world. So if they can continue to drive up sales, then it will help the whole industry, the EV industry, continue to become more recognized and more accepted around the world, which means that we all win if you're investing in EV companies. And for Tesla, that means that they get closer to realizing their valuation. They're valued at more than what Toyota and all the other car companies are worth combined. But is that justified, right? And we're still waiting to see if they can actually pull off full self-driving, right, or full autonomy. So the more that they can produce more cars, the better, and it gets them to a point where they continue to grow their market share and continue to hold on to the lead in this industry that they pretty much pioneered, right? So I'm happy with this report because I'm a passive investor in Tesla, but I'm skeptical because Elon makes bold claims often, but we don't always see it come through. So let's look at this. Let's look at the source. Where did I have that? Give me 1 second. Let me find the source of this report, and we can look at this. Tesla 1 million. There it is. So it says here on Tesla Oracle that Tesla is on track to produce 1 million cars this year, according to Musk, in a company-wide call. So the reporter is a Twitter user who says that Elon also said there was a chance that Tesla could produce and deliver 1 million cars this year. He also said Giga Shanghai was expanding a lot and rounded it off by saying this year will be great and 2022 should be even better. So yeah, I don't know. I'm happy for this rumor, this news, but I'm just waiting to see if they can actually do it. Again, Toyota sold 9.5 million cars in 2020, which is a lot more than Tesla, about 10 times more, if they can actually produce this 1 million and sell that. And okay, I like I said, I don't know if I believe that they can actually double their production capacity this year, but if they do, I'll be happy about that. But that's the news. So that's all I have for you today. There's not really much that went on this week. Of course, there's always stuff going on with each company that you might be investing in, but for my scope, I don't really have too much more. Let me just say thank you for being here and watching this video, this live stream. It's been a busy couple of weeks for me, and this week, of course, was even more busy. Started a new job, so I'm a little tired today. So I'm sorry if I'm coming off a little low energy, but that's the situation. I will be back with more videos in the future, and hopefully next week we can cover more news on the stock market, and I'll have a lot more energy at that time. But if you have been here and you enjoyed it, thank you for being here. And if you did like it, like the video below, subscribe to the channel, hit the notification bell, and let me know your comments below. And I hope that you have a good week. I hope that we have another week of recovery. We continue to go up, and that we don't see that flash sale or that flash crash, and everyone's wrong about the Great Reset. So I like where the market's been going this week. I'm up. I'm going back up about $20,000 this week. So I'm happy, and I hope that continues for the coming weeks. So again, thank you, and if you enjoyed it, you know what to do. I'm Lincoln with Bull